22. We are back on. Just want to say our next item is item 8, information consent items. I did not have any requests to pull anything from information consent. So we're going to move on to item 9, action agenda item, independent oversight.
Madam Chair,
Yes.
this is Pam. I see that we have a public comment for 8C.
8C?
8C, quarterly
Okay.
update, performance and risk.
Okay. And are we going to have that read into the record?
Yes, we are, Madam Chair.
All right, go ahead, Mr. Fox.
All right, so this is on item 8C. I'll read the name, the subject, read into the record their comments. I don't think we'll have any problem with their 3-minute time limit. Betsy Thagard, the 4/20/2020 Investment Committee meeting agenda item 8C. My comments relate to item 8C, your investments in fossil fuel companies waste my taxpayer money and potentially devastate my partner's retirement. The financial folly of fossil fuel investments due to volatility has never been more obvious. The recent crash in oil prices reveals just how dismal the financial prospects are for fossil fuel industries. A recent study showed that if CalPERS had divested 10 years ago, CalPERS would have generated an estimated additional $11.9 billion in value. Your failure to divest betrays your fiduciary duty to the people of California. It is morally obscene. And under current circumstances, it suggests a coziness with the fossil fuel industry that is unethical in the extreme. End email. Jane Scantlebury, subject, Investment Committee meeting 8C, risk and performance. Dear all, I am Jane Scantlebury, a retired public librarian, very fortunate to be a CalPERS recipient. I had planned to come to the investment meeting on March 16th. Alas, we are all at home, hopefully all well and taking time with reading and family. I'm also a member of Fossil Free California, a wonderful organization that is committed to making sure our grandchildren and their grandchildren will continue to live in a healthy world. This pandemic has presented us with the reality of life and death and our individual and collective responsibility to strive for safety and health. We have this same challenge to stop climate crises caused by the production and use of fossil fuels. Now is the time to divest CalPERS from fossil fuel companies. As we all know, it's an industry with a short future, a bad investment with a horrendous impact on our Earth and our future existence. Thank you for your time and consideration. End email. From Richard Godfrey, divesting from fossil fuel, item 8C. A letter to the Board of Directors, CalPERS, due April 20, 2020. Please consider and then act on the need to divest from the fossil fuel industry that threatens the health of the planet. Please reflect on the importance of your role in lowering the carbon dioxide greenhouse effect, in parentheses, 414.5 parts per million, that continues to threaten most at-risk populations around the world. It took 2 years for the city of Fremont to make a decision and divest, but they understood the long-term consequences financially and for the critical differences it would make for California. Your time is now. With respect, best wishes, and request that you act morally and with financial wisdom, Richard Godfrey. End email. From Dana Stokes, amendment to fossil fuel investments too risky. As a CalPERS retiree, I strongly urge the CalPERS Investment Committee to adopt a policy to phase out investment in fossil fuels. These types of investments have reached such a high level of financial risk and devaluation that they should no longer be a part of the CalPERS investment portfolio. Thank you for representing all present and future CalPERS retirees by taking this action. End email. From Louise Chiatovich, Subject CalPERS meeting 420 comments from retirees on agenda item 8C. Dear CalPERS Investment Committee members, thank you for continuing to represent us in this very important time to help sustain and improve our investment. I have been a member, now retired, since 1981. My husband is also a member since 1980. We are very concerned about the continued investment in fossil fuels given their grim projections for our planet, their growing crisis supply glut, and the dependence on the financial overestimation of in-ground assets. I, Louise Chiatovich, have attended several CalPERS meetings, submitted similar comments, and spoken about this issue at the UC Regents meeting on behalf of divestment of coal and fossil fuels on behalf of Fossil Free California. If CalPERS had divested 10 years ago, the portfolio would be safer and more financially successful. CalPERS has had a great opportunity now to move in a more sustainable direction and apply the strategy of moving from the high-risk investment of fossil fuels and to reassess the continuing growing cost of fossil fuel investment. Thank you for your consideration, Louise Chiatovich and Kevin Crawford. End email from Karen Jacques. Subject, CalPERS need to divest from fossil fuels. When I sent this email originally, I did not include the agenda item which it pertained to. The item is 8C on the April 20th agenda. My husband and I are CalPERS members, and we are also extremely concerned about the climate crisis. In the past, I've attended CalPERS hearings and pleaded for divestment from fossil fuels, as have many, many others. I want CalPERS to divest from fossil fuels because I want and the world needs a rapid end to the burning of fossil fuels because it is bringing our world closer and closer to catastrophe. I want CalPERS to divest because I am outraged by the destruction of land and the violation of human rights that results from fossil fuel extraction, from the construction of pipelines, from exploding oil/gas trains, and from their refining, all which has an outsized impact on poor communities and communities of color, including Native American tribal land and tribal lands in other parts of the world. In parentheses, remember Standing Rock, exclamation. I want CalPERS to divest because this is a moral issue. I feel sick that my retirement money and that of my friends and family is being used to fund climate, human rights, catastrophe. I want CalPERS to divest because it is one of the largest retirement funds in the world, and its divesting would set an example for the entire world and make a difference, a real difference. I also want to divest because fossil fuels are performing badly as an investment, and a growing number of reputable financial analysts and advisors are saying that their performance will only get worse as the world shifts to clean, renewable energy and as rational governments take action to protect the planet. And now the coronavirus adds one more reason for divestment because burning fossil fuels causes the kind of air pollution that makes people sick, and studies are showing that, other things being equal, people who live in areas with badly polluted air are more likely to die of coronavirus than people who don't. The UC system divested for financial reasons. If they can recognize the risk and they can make the decision to divest, surely CalPERS can too. Stop propping up a dying energy source that is killing all of us. Sincerely, end email. From Sarah Theis. Subject, comment on item 8C at the CalPERS Investment Committee meeting on April 20th. My name is Sarah Theis. I'm a CalPERS retiree and member of Fossil Free California. First, I hope that the board, staff, and all those listening are safe and healthy. I know everyone at CalPERS is doing their best in these very difficult times. I hope you will hear my remarks in that light. Last year at the March 2019 Investment Committee meeting, I commented on CalPERS Sustainable Investing Program. I don't understand why this and other items that were previously part of the open session are now in the closed session. CalPERS may hold closed meetings, in parentheses, when considering investment decisions, in parentheses. However, for years, CalPERS has been successfully separating discussions and decisions regarding actual investments from reports on outcome and policy. I hope that these changes in the agenda are a temporary measure. If not, I request that one or more board members agendize this for the public portion of the next investment committee meeting so that staff and the board can explain to CalPERS members, retirees, stakeholders, and the public why these changes are necessary and lawful. You know well that oil and gas are among the industries hardest hit by the current crisis, with leading companies losing an average of 45% of their value since the start of 2020. What I want to speak to is not that, but the fact that even some Wall Street types are advising investors to dump fossil fuel stocks. Moreover, the reputational risk of holding these stocks is apparent even to television pundits like Jim Cramer, who in January announced on his program the death knell of fossil fuels. He went on in quotes, "Fossil fuels, they're just done. We're starting to see divestment all over the world. It's going to be a parade that says, look, these are tobacco and we're not going to own them." End quote. Given the financial volatility of fossil fuel investments and their decreasing attractiveness to investors, it makes sense to use the current situation to begin a long process of winding down CalPERS fossil fuel investments. I ask the board to start this process now. Thank you. End email. From Lynn Nittler. Comments to CalPERS Investment Committee on April 20th for agenda item 8C. Members of the CalPERS board, I am Lynn Nittler, a retired teacher on a CalSTRS pension with my health care through CalPERS. Thank you for the opportunity to offer my written comments. I am glad the CalPERS is cautious with the pension money I depend upon for my health care. Our present circumstances with the COVID-19 pandemic certainly illustrates the need for long-term sustainability and caution in taking risks. As an advocate of eliminating fossil fuels from the CalPERS portfolio for the sake of preserving a livable climate on Earth, I am actually proposing a cautious approach to risk by calling for divestment. Fossil fuel assets have been losing value for a decade now, and they are in danger of becoming stranded assets. The corporate Knight report revealed that had CalPERS divested from fossil fuels 10 years ago, CalPERS would have generated an estimated additional $11.9 billion in value. In other words, CalPERS would do better financially to divest. Simultaneously, by divesting, the planet gets a chance to breathe, like we are experiencing around the globe by sheltering in place. The spectacular views as the air clears in the most polluted cities around the globe are a welcome relief, and most people want to keep the air that clean to protect their health. It is equally compelling that if CalPERS fails to divest its fossil fuel holdings from its current $394 billion, or however much remains now since COVID-19, then its guaranteed physical impacts such as rising sea levels, fiercer storms, and heat waves will become the norm as climate change progresses. CalPERS prides itself on its concern about climate change. Then surely it would be wise not to hold investments that contribute directly to making climate change worse. Thank you for your consideration. End email. From Glenn Fieldman. Comment at the Investment Committee for 2020 Agenda Item 8C. Dear members of the Investment Committee, it is time to get CalPERS out of fossil fuels. I write as a still employed CalPERS member and soon to be retiree with an anxious eye on both the health of the fund and the health of the climate. The fact that fossil fuels stock values, especially in oil, have taken a coronavirus-induced nosedive should not blind CalPERS investment managers to the long-term decline in the value of these companies. Governments and consumers are waking up fast to the terrible climate corner we've painted ourselves into and the need to take drastic action to get out of it. Threats to land and water posed by new fossil fuel projects and infrastructure and attacks on people who want to protect their land and water are further eroding the legitimacy of the whole industry. Policy action to reduce emissions becomes more and more likely despite the desperate rearguard battle fought on behalf of fossil fuels by their friends in the Senate and the White House. Falling renewable prices, now followed by falling energy storage prices, are putting an all-electric energy system within reach. It is no wonder that the value of fossil fuel holdings is declining. Nor is there any reason to think that it will recover. While fossil fuel stock values have always been notoriously volatile, the industry has never before faced the threats or the viable competition from alternative energy sources that it faces now. Despite the claims of more progressive fossil fuel companies like Shell that they will be carbon neutral by 2050, They have not to date offered a plausible plan to achieve that outcome. So why CalPERS continues to hold on to these stocks is a mystery. This investment inertia, I believe, represents a real threat to my pension and to those of hundreds of thousands of others. You meet today on the 10th anniversary of the blowout of the Macondo well in the Gulf of Mexico and the destruction of the Deepwater Horizon drill ship that killed 11 people and injured many others. I read today in The Guardian of Mexican fishermen and their families whose livelihood was ruined by that spill. The abundant shellfish that allowed them to send their kids to college are completely gone. BP has ignored their request for compensation. Please consider the scope and scale of the disasters that the fossil fuel industry has wrought already and the dreadful future, social, financial, and ecological, that is in store if we do not end our relationship with it and do the right thing. Divest from fossil fuels now. Thank you. End email. From Deborah Sylvie. Comment on item 8C at the CalPERS Investment Committee meeting on April 20th. My name is Deborah Sylvie. I am a CalPERS retiree and the former president of Fossil Free California. I spoke before you at the March 2019 Investment Committee commenting on the report on CalPERS Sustainable Investing Program. It disturbs me that this item is now part of the closed agenda. I realize that CalPERS is legally permitted to hold closed sessions when considering investment decisions. I do not recall any discussion of investment decisions at last year's meeting. I hope that the movement of this and other items from the open agenda where they have been for years to the closed portion of the meeting is a temporary measure. I and other members of FFCA have been attending these meetings since 2014, expressing our view that it is bad for the planet and our pension to keep investing in the fossil fuel sector. Never has this been more true. First, we watch with horror as COVID-19 kills tens of thousands and brings untold suffering to millions across the globe. Extreme crises like these will become more common as climate change accelerates. Second, fossil fuel investments have dropped through the floor, though the energy sector was in crisis before the pandemic. In the past 5.5 years, the S&P surged more than 70%, outperforming energy stocks by 100 percentage points. And it's not just fracked shale oil companies, which are highly leveraged and never made money. They are in trouble. Big oil is also having major problems getting the capital it wants. Both BP and Exxon plan to sell assets to cover expenses, but as of this past week, buyers cannot find willing lenders. Shell also needed asset sales to cover dividends and buybacks. For these reasons and many others, I request that this board instruct staff to report back on the fund's exposure to fossil fuels and begin the steps needed to transfer its assets from fossil fuels by a certain date. Thank you. End email. And finally, Arnold Erickson, subject fossil fuel investments. As a CalPERS member, retired, I want to express my concern with investing in fossil fuels, whether viewed as a matter of environmental necessity or financial policy. It is time to divest. End email. And that concludes public comment on item 8C, Madam Chair.
Okay, thank you. Just making sure nobody wanted to comment. Okay. I appreciate that, Mr. Fox. And we're going to move on to item 9A, action agenda item, independent oversight, contracts administration, general pension board investment consultant. I think that's Dan, right?
Thank you, Madam. Yes, ma'am. Thanks, Madam Chair. In the interest of time, I'll keep this brief. Andrew Junkin has left Wilshire effective the middle of this month, and this agenda item is to remove him as a key person in the contract, which does require board action. This leaves the following key persons in the contract: Tom Tote, who you heard from earlier today, Steve Foresti, Rose Dean, and Ali Kazemi. And as I say, this is an action item, so the recommendation of management is to make this change, but we're happy to take any questions.
Okay, so I don't see, oh, I do. I'm sorry, Mr. Jones, go ahead.
Yeah, thank you, Madam Chair. I move approval.
I'll second that.
Sorry, I clicked on something else. Mr. Jones moved approval for item 9A. Mr. Miller, I believe, seconded the motion, so we need to take a vote.
Madam Chair. Rob Fechner,
Aye.
Henry Jones,
Aye.
Lisa Middleton,
Aye.
David Miller,
Aye.
Stacy Oliveris.
Actually, I had a question, but we just went to a vote.
Oh, I did not see it till just now, Stacy. I'm sorry.
So
So
how
hold
should I
off on the
proceed?
vote and we'll redo the vote. Go ahead, Stacy.
So it's been my experience with key man provisions that then the contract has to be evaluated again. Is that not the case with CalPERS?
Dan, you want to answer that? No, we can make an amendment with action from the board. And for what it's worth, we actually just went through the process to renew the contract with Wilshire. So the next contract will be for the years 2020 to 2025 with these four key persons if the board approves this.
That's significant. Given that he's been our primary contact.
So I just, all of these people are also on the contract.
I understand
believe.
that. Yeah, I understand. But he was our primary contact.
Anybody want to address that?
I mean, I would say, Andrew was the president of Wilshire Consulting, and yes, he was our primary contact for quite a while. Although I will say that, Steve, Tom, Rose, and Ali are very familiar, I would say, to the relationship. They were also on the panel that presented at the to the subgroup on the RFP process. So, as I say, management would recommend just making the update to the contract, but certainly open to to other ideas, or as I say, it is an action item for the board.
Okay, so we had a motion by Mr. Jones, a second by Mr. Miller. I'm going to continue the vote unless I hear something else from anybody else. So, Pam, if you want to, oh, I see a hand raising. I'm sorry. Go ahead, Ms. Middleton.
Dan, given how quickly the resignation came after the RFP was completed, is there any reason to believe that Wilshire failed to disclose to us that there was a pending departure of Mr. Junkin?
Ms. Middleton, I don't have any reason to believe that. As I say, I do think that we are very familiar with Steve and Tom and Rose and Ali. We're optimistic, and I've actually spoken to Andrew since he left, and one of the things that he said was that he's happy with the team that he's built. And he thinks that the service can continue, but I don't have any reason to believe that. But the timing does follow closely, candidly.
If there was a reason to believe that, if that was to become apparent at some time in the future, that would be a concern to me, and I think would warrant us revisiting the contract. But absent any evidence of that, I'm comfortable with moving forward.
Okay. Pam, if you want to continue, I think we have some people's votes on. Oh, Betty, did you want to talk?
No.
No? Okay. Sorry, I saw your mic was off, but anyway, go ahead, Pam.
Okay, would you like me to do a revote or just continue on?
Just do a revote. Let's start over. We have a motion and a second, Mr. Jones and Mr. Miller. So go ahead and do the vote over.
Okay. Rob Fechner,
Still aye.
Henry Jones,
Aye.
Lisa Middleton,
Aye.
David Miller,
Aye.
Stacy Oliveira,
Abstain.
Jason Perez,
Aye.
Ramon Rubalcaba,
Aye.
Betty Yee.
Aye.
All right, motion carries. Thank you, everybody. We're moving on to 10, information agenda item, trust fund, trust level review consultant reports.
Thank you. And Jared, if we can move from attendee to panelist, if we can move Tom Toad and Steve McCourt from attendee to panelist. This is the trust level review, the semi-annual where the consultants go first. So we'll start with Tom and then over to Steve, and then it goes to staff.
Okay, Tom and Steve, you should be able to turn your video on and make comments.
Fantastic. Thank you very much. And we do appreciate the discussion on the last agenda item. I did want to make one comment specific to Ms. Middleton's question. I can say without reservation that we did not hide or have any knowledge that Andrew was going to be leaving us. I have been fortunate enough to work with Andrew for about 15 years, 10 years of those on the CalPERS relationships and we've become quite close. And so this was not something that was on our radar. And second, as soon as we found out about it, we were immediately on the phone to the CalPERS organization to inform them of that. And that was prior to the contract being signed. So we pride ourselves on being upfront. And I just wanted to make that one comment, recognizing that you've voted.
Thank you. I appreciate that.
Of course. So I'm going to be quite succinct here because I think the information provided here as of the end of last year doesn't have a whole lot of bearing on our current situation. But I do think it's helpful to provide some context of where the portfolios come from.
Lost the sound.
Can you hear me?
I can't hear.
I can hear Henry.
Now I hear you.
It can, okay, it looks, maybe it just started speaking too fast. Please let me know if that cuts out again. So as I was saying, I think while the information here doesn't have a whole lot of bearing on where we are now, given the extraordinary market events related to COVID-19, I do think it's helpful to provide some context in terms of where we've come from. As you look at, I'll have you move to item 10A, page 2 of 45, and the following pages. By and large, the statistics that you see here and the picture that they paint are quite different from where we find ourselves now, with growth in the U.S. Being expected at the end of the year to continue at about a little bit below 2% pace. That's been completely thrown out the window with the slowdown related to COVID-19. As Ben alluded to in his comments to start open session, we're now looking at growth down 3% globally. And these expectations are really all over the map in terms of how steep the drawdown is and how quickly the recovery comes, whether it's going to be V-shaped or U-shaped. I maintain a relatively cautious view here, given that the uncertainty around the spillover effects are quite extraordinary. And I think I wanted to make one comment around investment risk versus uncertainty. We're living in a very uncertain world, and I draw the distinction between that and investment risk because it really, I think, highlights the challenges with this pandemic in that uncertainty is not really quantifiable, whereas investment risk is understanding what a distribution looks like and being able to construct a portfolio to manage through that distribution. The current situation does not lend itself to that, and there's so much uncertainty around what the infection rate actually is, how long it's going to last, how long it's going to take to come out of lockdowns, even in a staged manner, and the effect that that's going to have in sectors really around the globe. A couple of other statistics as we flip through the next couple of pages. I won't really even ask you to go there. But unemployment claims, as everybody is aware, are orders of magnitude higher than we have seen previously, really from the full historical record. If I have you flip to page 92, just so you have something to look at. This is our risk monitor, which is a standard report. I'm sorry, that is page 5 of 45, page 92 in the board packet. The risk monitor now shows a sharp uptick at it's really actually hard to see on credit spreads, both investment grade and non-investment grade. The stress index has also moved materially higher, and the volatility index related to equity markets has also jumped quite precipitously, all very different from the picture that's painted in these charts. On the very next page, you can see the short-term rate, where it sat and where market expectations were going forward. That dark blue line is now down at 0. So substantially different from the market environment we saw at the end of 2019 and going into 2020. So what does that mean for our asset class assumptions going forward? There are a few notable things to point out. If you flip to page 7 of 45, our global stock expectations currently are about 1% higher than those figures shown on this. At 6.2%, our expectations now sit right around 7.2%. At the same time, our core fixed income expectation has come down by about 1% to 1.8%. So the risk premium associated with being in equities relative to fixed income has shifted. And that's an important consideration as we look at the impact of our asset class risk and return expectations as we go through the mid-cycle ALM review and then on to the full-blown ALM review later on. I think it's important to remember that risk premium, just because it has expanded, that doesn't necessarily mean it's going to contract in a rapid fashion. And I think a lot of that has to do with that risk versus uncertainty dynamic I started off the discussion with. I think investors are going to appropriately look at the potential for a second wave around the globe and the impact that would have on economic markets, and taking that into account when they're looking at how to position their portfolios. And so I think it's important to be prudent and to really stress the benefits of rebalancing based on your strategic plans as the best way of managing through these very quick short-term dislocations, with the eye to planning strategically, utilizing the best available information in the asset liability, the asset allocation work that the board and the investment committee is tasked with. I will ask that we flip forward more for the record than because it's particularly relevant, to page 11 of 45, and this is where I will stop. Over 2019, the portfolio was up just over 17% at 17.3. It was almost right in line with its policy fund benchmark. The slight underperformance from public equity was offset by positive contributions from private equity and fixed income, and a substantial positive impact from the real asset portfolio. So I say that, and I'll stop there in the interest of time and see if there are any questions from the committee members.
Oh, I turned my camera off too. It looks like, is that Henry? Did you have a question? You're on mute.
Thank you. No, that was a previous item.
Previous? Okay. So I don't have any questions. So if you want to...
I will turn it over, I believe, either return it to the chair or to Mr. McCourt from Nikita.
I think we are, hold on a second. Yeah, go ahead, Mr. McCourt.
Great. Thank you. Am I coming through okay?
Yes, I can see you this time. I couldn't see you last time.
Excellent. So we provided in your material our private equity, real estate, and infrastructure semi-annual reviews. I'll be going through just some verbal summaries of each, and then happy to answer questions afterwards. I do want to note that our real estate infrastructure and private equity teams are on the phone as well if there's more detailed questions that the investment committee has. I'll start with real estate, just going from largest to smallest private market asset class. As of December 31st, the real estate portfolio was valued at $36.8 billion. That was 9.3% of the total CalPERS fund. For the period ending December 31st, the real estate portfolio was performing in line with expectations. Over the previous 5 years, the core real estate allocation, which represents nearly 90% of your total real estate now, returned 10.9% versus 8.3% for the benchmark. So the forward-looking real estate continues to perform very well. The non-core legacy real estate assets have now been reduced over the last 5 years from 50% to 15% of the overall real estate portfolio. And the intention is to reduce that to 0% over time. At the end of the year, lower risk core real estate represented 87.1% of the real estate portfolio. And in aggregate, that core real estate was in excess of 92% occupied and generating more than 4% annual net distributions. The real estate portfolio was leveraged conservatively at a 30% loan to value and over 3 times debt service coverage ratio. The focus on high quality assets in the property types we believe will benefit CalPERS during this current downturn. While the CalPERS portfolio has a modest overweight in retail, it has almost no hotel or hospitality exposure, which has been other sectors that have been hit hard by recent coronavirus events. And finally, the real estate portfolio was in full compliance with all policy parameters. A quick note on the market for real estate. Much like the rest of the capital markets, the condition of the market throughout 2019 and the first month and a half of 2020 no longer is all that relevant. We've shifted to a economic environment where interest rates are much lower and economic activity is much lower as well. In the real estate space, that's likely to manifest itself in a variety of ways. While through March 31st, we believe, based on conversations with real estate managers, that real estate valuations will likely hold up fairly well. We don't expect the industry in the aggregate to see significant losses. We do expect that over the second and third quarters of this calendar year, you're likely to see reductions in the value of real estate properties as you roll on to full quarters of reductions in rent and cash flows, somewhat offset by the reduction in interest rates, which are used to discount those future cash flows. I'm now going to switch on to private equity. At the end of December 2019, the private equity portfolio was valued at $26.1 billion. That's 6.6% of the total CalPERS portfolio. Approximately 2/3 of the private equity portfolio is invested in buyout strategies. Buyouts and all other sectors were near policy targets at the end of the year. In terms of vehicle types, 69% of the private equity portfolio was invested in funds, 18% in customized investment accounts, 5% in co-investments, and 8% in fund-of-funds or secondary funds. Roughly 60% of the private equity portfolio was US based and 40% non-US. Since 2011, now a total of $34.3 billion in cash has been returned to CalPERS, net of all contributions, fees, and expenses into the private equity program. And for calendar year 2019, net cash flow was $2.5 billion. For the calendar year, staff committed a total of $6.9 billion to private equity investments. That was the highest total since 2008. From a performance perspective, the private equity portfolio produced a return of 2.9% over the trailing year, exceeding its benchmark by 30 basis points. I'll make a note, much like real estate and infrastructure, these performance numbers are based on valuations through September 30th as opposed to December 31st because of the lag. Over the last 10 years, private equity returned 12.4% per year, 1% per year behind CalPERS private equity benchmark, but 3.4% per year in excess of global public equities over that 10-year time frame. From a performance perspective, while it still is a smaller but growing segment of the private equity portfolio, co-investments have continued to be the strongest investment vehicle for CalPERS. In terms of the market for private equity, 2019 was a very strong year for the market in terms of transactions, capital flows, and valuations. That has all changed in the last 6 weeks. The private equity transaction volume has slowed considerably since the coronavirus and the shutdown of the global economy as a consequence. It is too early to know the performance impact of the asset class through the coronavirus slowdown. Our early indications are that we're likely to see first quarter returns for the asset class down in the neighborhood of 5 to 15% in aggregate. But we'll learn a lot more over the next few weeks and quarters. And much like with real estate, the bulk of the economic impact on private equity is likely to be felt in the second and potentially third quarters, as the first quarter only saw about 6 weeks of the shutdowns. And finally, I want to summarize our infrastructure review. At the end of December, the infrastructure portfolio was valued at $4.7 billion, largely unchanged from the end of 2018. It represented 1.2% of the total portfolio. The infrastructure portfolio was in full compliance with all policy parameters at the end of the year. As a reminder, like real estate, the vast majority of infrastructure that you have is in core assets, which are intended to be more defensive than value-added or opportunistic sectors of the market. 83% of the assets were defined as core at the end of the year. 56% of the infrastructure assets were in the U.S., 44% outside the U.S. And leverage on the portfolio was well below policy limits. The loan-to-value ratio of the portfolio was 44%. The policy maximum is 65%. The performance of the infrastructure portfolio for CalPERS continues to be superb. The 1-year return was 7.3%. That was 2.8% above the infrastructure benchmark. Over the trailing 10 years, infrastructure posted a return of 14.6% per year. That's a full 8.6 percentage points per year above the return of the benchmark. Much like real estate and private equity, it's a little too early to tell what the economic impact on infrastructure assets will be. Within infrastructure, the types of assets that are likely to be most affected by the slowdown in economic activity include transportation assets like ports, airports, and toll roads, midstream energy assets, pipelines and storage facilities, and some utilities. In the aggregate, the asset managers we speak with, much like private equity, are guiding first quarter returns in the neighborhood of -5 to -10%. But the bulk of the impact from the economic slowdown is more likely to be felt in the second and potentially third quarters. With that, I will conclude and happy to answer any questions that the committee has.
Thank you, Mr. McCourt. I do have some questions. First, Ms. Olivares. You're not on, Stacy.
Can you hear me?
Yeah, now I can.
Okay, I don't know what happened there. This is actually for both Mr. Toth and Mr. McCourt. So as we've gone to a quarterly meeting system for the investment committee, and we are in the middle of a recession, maybe a protracted recovery, I'm wondering if we can get reports on a quarterly basis.
From Makita's perspective, we're happy to provide reports as frequently as the committee wishes.
Thank you.
And I'd echo that from Wilshire's perspective. We're happy to provide them as needed to ensure you feel well prepared and well informed.
Thank you. I'd appreciate that.
Thank you. Next is Ms. Middleton.
Thank you, Madam Chair. This is for Mr. McCourt and specific to real estate. Two questions for you. Are you concerned about the amount of retail that is in the portfolio? And then secondly, and I'm looking at page 207 in our report on performance by geography. And I note that the asset value is relatively small, but we underperform exceptionally poorly in Asia. Do you have any explanation for that, and what does that foretell for the future? Thank you. And I also will have a question on private equity later.
Great. So I'll address retail and Asia, and I might invite staff to provide a response as well if helpful for detail. The non-U.S. assets in your real estate portfolio are largely legacy non-core assets. They're not part of the forward-looking strategy of the real estate portfolio. With respect to the retail allocation of the portfolio, we do believe the real estate portfolio is well diversified by sector. We also believe that on the whole, the quality of assets that CalPERS holds within its real estate portfolio are of somewhat higher quality than the industry as a whole. The final thing I want to note with retail is CalPERS took the step last year, well in advance of the real estate market at large, of writing down the value of its real estate retail assets when it became apparent that retail traffic, well before coronavirus, was declining because of the so-called Amazon effect. So we view that as the responsible thing to do, and also sort of highlights the level of conservatism in the management of the real estate portfolio.
Thank you. And with regard to private equity, that is certainly something that we are trying to increase. How concerned are you about increased volatility and risk in the portfolio as we increase private equity holdings?
Well, the volatility of the markets and the portfolio as a whole challenges private equity in a couple of different ways. From a strategic perspective, probably the most significant impact is on the pacing of the private equity program. If public market stocks are moving up and down quite rapidly, as they have for the last 6 to 8 weeks, and they may continue to, it makes it a little harder for staff and all investors to plan for how much capital they should be deploying in private equity in order to achieve a target allocation. Staff is aware of that, of course, and is constantly reevaluating pacing models to make sure that the commitment pacing is appropriate given the market volatility that we're seeing. The other impact that volatility has on private equity, I would argue, is quite positive, in that the volatility brings, for the first time in likely a decade, likely some better valuations and entry points for new capital being put into the space. So as we've reported, and staff for it seems like 5, 6, 7 years now, for all of these private market asset classes, the biggest challenge has been valuation in deploying assets. And the silver lining to the volatility in the markets is that going forward, one would hope that there's stronger and better valuation for new capital being invested in those markets.
Thank you, sir.
Ms. Yee?
Thank you, Madam Chair. Actually, also on private equity, I was noticing on, I think it was slide 5, about the pace of commitments, and it looked like it may have slowed in the second half of the year, and just wanted to see what that was attributable to. I think it went from 9 to 3. Whether that was a change in the quality or the lack of quality investments, or whether there was a change in strategy, lack of staff resources. What's your observation there, Steve?
Again, I'd be happy to have staff comment on that, but from our perspective, the commitments every year tend to be lumpy in terms of when they occur during the year. We've not seen any change in pacing that would cause us to believe that there's concerns with staffing or concerns with the ability to appropriatly pace commitments over time. In fact, the commitments that staff has made to private equity funds and co-investments has markedly increased the last couple of years. So I think it's been on the right trajectory.
Thank you.
Okay, I'm not seeing any more questions. I want to thank Mr. McCourt and Mr. Toth for going through this with us, and move on to, unless there's any other questions, I want to move on to CalPERS Trust Level Review, which is 10B. Is that Dan again?
Good afternoon, Madam Chair. This is Dan Meng. Actually, this item will be covered by our Chief Economist, John Rothfield, and Eric Beckson, the Managing Investment Director of TLPM. With that, I turn over to John and Eric. Eric and John, are you on the line?
Hi, Eric and John. You should be able to share your video and audio.
Yes, Ben, I'm online, John Rothfield. I think we were starting with Eric, but Eric not there?
So why don't you start first while we're waiting for Eric?
Okay.
I'm here now, Ben.
Oh, okay.
Sorry,
okay.
the muting wasn't working okay. Anyway, it's Eric Baggison, Managing Investment Director for Trust Level Portfolio Management. And obviously, a lot of the material in this presentation is incredibly dated now that we've had 3 or 4 months of just unusual activities. Maybe if we could just turn to page 4 of the presentation material. Okay, I think I'm only going to make a couple of short comments before turning it over to John Rothfield. But I thought that one of the elements that the board would very much like to understand is sort of the performance impact of the events that we've seen taking place. If you look in the last column on page 4 in the table, you'll see that the year-to-date, fiscal year-to-date return for the fund was 5.6%, as of December 31st. As of March 31st, the return to the fund had dropped almost 960 basis points to just being negative, just over 4%. Now we move forward through the month of April, at least through last Friday anyway. The returns to the public markets had actually been quite positive through last Friday. They had increased by almost 5%. So our best guess at the moment that the annual fiscal year-to-date return for the fund is going to be somewhere right around 0%, right about flat. And I think now if we could just turn to page 6 of the presentation material. I just wanted to make a couple of comments about the positioning of the fund, and one comment echoing back to Ms. Oliveira's question about the COVID-19 effect on the risk mitigation or diversification in the portfolio. So first, the positioning of the fund, we're slightly underweight to the public equity markets. And when I say slightly underweight, it's somewhere about the 1% to 1.5% range. That underweight is offset by a slight overweight to the spread segment within the global fixed income portfolio. Our private assets, which have not been marked to market for the effects of the virus, have moved closer to their target allocations. We were approximately 1% underweight to private equity as of the December 31st time period, and about almost 2% underweight to real estate. We're now about 50 basis points underweight, or 0.5% underweight to private equity, and the real estate weight has moved within about 100 basis points, or 1% of its target. In relation to the risk comment, and Ms. Oliveira, I thought that was an interesting question that you asked about the effect of the virus on the risk mitigation efforts. And this is actually a discussion that we're having currently within the investment office about the ability of the Treasury portfolio to continue to provide the sort of downside protection once you've reduced interest rates to the level that they currently exist in the portfolio. So that'll be a discussion that we're having, as I say, within the investment office, and really trying to understand what the implications of that are. And I think that'll be part of the topic that'll come back to the board when we bring the midpoint review around the month of June. And I think without belaboring this now, I turn it over to John Rothfield and let John give you a little bit of background or information around the actual economic structure that he sees going forward. So John?
Yeah, thank you, Eric, and thank you for the opportunity to speak to the board. Maybe we could turn to page 10 of the slide presentation. The economic environment has changed a lot since these slides were put together and represent what the economy looked like at the end of the calendar year, so halfway through the fiscal year. But they are slightly relevant because the economic cycle is a continuum. So it is important to note that at the end of last year, the US economy had grown by 2.3%. That was very much the average for the 10.5-year expansion cycle. And so the so-called volatility of growth had come to an all-time low. So the predictability of the kind of growth we were getting in the economy had become greater than it had before. However, more and more, the economic expansion had been relying on the pillar of the consumer, their employment, their income, and their spending. Because of a lot of global destabilization, including trade wars and trade engagement in general, the CapEx side of the economy, the business CapEx side of the economy had come way off. That said, and that is why the estimate for growth at the start of the year was the US economy would only grow by 1.9% this year, so it would come down. But the International Monetary Fund had expected the global economy to grow by 3.3%. The main problem concerning the economy had been that the labor market was starting to get tight. At the height of the last recession, we had 14 million people unemployed, 14 to 15 million. And as of the turn of the year, we had only 5 million people unemployed. That sounds like a large number, but it's basically frictional unemployment when you get down that low. Well, fast forward to where we are now, we have an additional 22 million people just in 4 weeks receiving unemployment benefits. So they will be officially called unemployed. And suddenly the unemployment rate, which during the global financial crisis took over 2 years to go from 4% to 10%, is probably going to print in the next couple of months somewhere between 20 and 25% of unemployment in the economy. So we are in markedly different circumstances. The economic expansion probably will almost certainly end in the month of February. And so the task of macro and the economics in the macro has been trying at the total fund level to be a decision input to the investors in the fund about some key metrics around what happens now. And I just wanted to mention 3 points which I think are decision inputs. One is the depth, shape, and length of the current recession, presuming that the expansion ended in February. I'll throw a couple of numbers at you. One is the shortest recession since the World War II has been 6 months. The average has been 11 months. The GFC was 18 months. The 6-month time frame was initially proposed because folks thought about this as a disaster recession where there would be a collapse in economic activity and then a fairly quick return to work. Well, it's not turning out that way. And basically the recession is looking more like a U or a W, where you have a relapse into a second leg of lower activity based on a flare up again of cases and various other factors in the economy, or even an L, which is a much longer stagnation of the economy. And the main factors that go into the issue here about the shape of the recession and the recovery go to the issue of income replacement. So there are 3 large programs out there now to supplement income. So the payroll protection program, the Main Street lending program, and enhancements to unemployment benefits. They are all an effort to make income to unemployed people whole by promoting the idea of retaining employees, or if you are laid off or furloughed, to try and make whole your income. Those programs together, once the PPP is enhanced, could amount to $2 trillion, which is about 10% of 1 year's growth through the end of this year. And the second element, of course, is how quickly we can destage the lockdown that we've been in now. And there's a huge amount of uncertainty around that, particularly if we have to go back into lockdown. I would say that in reviewing all the numbers, I would think we're more likely to be in a recession that's somewhere between the average of 11 months and the GFC of 18 months. I think the idea that the recession is going to be over fairly quickly is probably misguided. The second element, the second question that macro is asking is, what is the impact of all of the quantitative easing that has resumed in the economy? Well, it's expected that this year that central banks around the world will add about $8 trillion in money supply to the economy by buying risk-free bonds, but also other kinds of bonds in the economy. Just in the last 4 weeks, they've added around $3 trillion, including more than $2 trillion by the Fed. The announcement effect of that and the pure growth of money supply, which is now 15 to 20% a year, almost double what it got to in the GFC, that is expected to promote some kind of at least temporary asset price recovery. And that's basically what we have seen since the central bank started to do that. So I think it is an important question. The response of the central banks and also the governments has been so aggressive and so proactive this time that at least it temporarily alleviates the downside pressure that we've had on asset prices. And then as a long-term investor, probably the most important question is this the kind of recession that forces the US economy into more like a secular stagnation or one of the terms used is Japanification of the US economy. To give you an example, it's been 7 years since Prime Minister Abe in Japan introduced a program that's taken the central bank balance sheet from 30% of gross domestic product to 110%, massive increase in their purchase of assets. It's been 8 years since then ECB chief Draghi delivered his whatever it takes statement. And since then, the ECB over 8 years has reduced interest rates to minus 50 basis points, and they've continued to do a lot of quantitative easing. And by the way, it took 7 years from when Bear Stearns collapsed in the US to the end of the quantitative easing program, and 8 years before the Fed was able to start raising rates again. So I think one of the more negative elements to this is, firstly, probably the recession is going to be longer than the hoped for minimum of 6 months we've experienced since the war, and it's not evidently the case that that's priced in. Secondly, things like quantitative easing and income replacement can have a temporary impact on asset markets, but not a permanent impact. And thirdly, we are in a situation where even as the economy comes back to work, folks are going to have to replenish their savings. They're going to be cautious. There may be structural changes to the labor force. These programs will tend to keep weak companies alive, and supply chains have to evolve over time. So we don't necessarily get capital spending, we get supply chain reorganization, if you like, not only due to coronavirus, but also some of the geopolitical factors around the world right now. So I think the overall message is not to be too optimistic about how we come out of this recession and what lies ahead of us in the next 5 to 10 years, but also that it does pay investors to be dynamic. Central banks have reacted aggressively and proactively, and there are going to be opportunities and relative winners and losers in this process going forward. So I think they're the main two messages from the macro.
Okay, thank you, John. Thank you, Eric. I just had I don't see any questions from anybody else, but I had a couple of questions for you, John. One, you mentioned that people are concerned about how this would impact the purchasing of, oh man, I'm so tired, my brain's gone. As we invest in the market, as the United States is investing in the market, pushing money into the market, you had said that people were concerned about that. I had read an article, I thought that we were, and you just mentioned about Japan, that we were going to get close to 100% of GDP that we're spending in the market alone. Is that correct?
I don't think we get to that level. I see numbers saying that by the end of the year, the Fed's balance sheet should be something like 40% of our gross domestic product. Then, of course, on top of that, you can be adding some of the government programs as well. No doubt the Fed, as the government rolls out these programs, it does mean a larger supply of bonds, which may increase what the Fed buys. So I think we're on our way from 25 to 40%. We're not on our way from 30 to 100%. Unless this is a really bad and prolonged situation. I think one of the positive messages is you could argue that in terms of being having some of the characteristics of Japan, like an aging population, less dynamic structure, the US is still some way behind Europe, which is still a little bit behind Japan. So if we are able at some point to have a vaccine and we are able to improve our situation in terms of this kind of spending that people can do, then we may be able to avoid the endless cycle of central bank and government support for markets that we've seen in Japan and to some degree Europe.
Yeah, I would hope so. I feel like that's a tool that we first came up with in 2008, and we just use it for everything now. And as we're watching, you did say earlier, the Paycheck Protection Act actually is not working real well right now.
I think the problem with the Paycheck Protection Act is that it was too small, and a lot of businesses closed down before they found they were eligible for it. So I think what you're going to see coming out of Washington fairly soon is a bipartisan effort to increase the size of that program. And also, you do hear from a lot of displaced people that the unemployment benefits for self-employed and gig workers has been rather confusing and slow to get up. As I say, I think income replacement can only work for so long. Ultimately, you have to get market forces and human spirit, etc., driving income creation. If you have income replacement that could potentially go away at the end of the year, you do tend to get people saving more of that income for a rainy day, and I think you're going to see more of that happening.
It's amazing what happens when who ran for president anyway that was talking about a universal income. I just had one more comment, and then I have someone else. So you had talked about the supply chain, and I think it's really relevant here that the supply chain is disrupted because people can't work. And I think that I wonder what your take is on the human capital. Somebody gets sick, and then the entire world gets sick, and our workers can't work. I just wanted to know if, that's a huge disruption of the supply chain, let alone just working people here. So I wonder if you could comment on that as a risk that we hadn't really taken seriously.
Yes, I think we had started to take that seriously toward the end of the last year because of disruptive trade engagement that was happening, and also the technology, the adversarial relationship with China with regards to technology, etc. So there are two views on what happens to supply chain. One is it becomes less complex and more investment returns home. Another is it becomes more complex because you need alternate suppliers. Let's face it, every country is closed down from every other country. A country like Vietnam has hardly, its case rate in coronavirus has been relatively small, maybe no deaths. In one scenario, supply chains become more complicated, where you get backup supply happening. The idea that all that countries are going to go back to home base. Hopefully, there'll be some of that with regard to the US, but more likely than not, it's going to become a complex issue, and firms are going to have to deal with it in a strategic manner. And they're not going to be able to necessarily increase their investment. They're going to divest in one area and increase their investment in another.
Do you think that's human capital that's managed here in the United States differently than a lot of Western nations, because we don't have sick leave, we don't have healthcare? Does that disruption also make it more complicated to get back to where we were?
I think so. One of the reasons that supply chains had been becoming more complicated anyway since 2012, 2013 had been that China's all-in labor costs had been rising up toward the average of other countries. So that's why you're starting to get a devolution into places like Vietnam and Malaysia and Thailand, et cetera, with supply chains. So that's all part of a decision-making process. What's the cost of labor, but also the reliability of labor, right? If there's a safety net, et cetera. So I think that, in terms of stability of supply, companies probably take these factors into consideration.
Great, thank you. I have a question from Ms. Middleton.
Right. Thank you, Madam Chair. And John, thank you. Very enlightening. My first question, you spoke of the economy prior to COVID-19 being exceptionally reliant on the consumer. And there's
That's right.
every reason to believe with an unemployment rate that's going to hit 20%, that the consumer is going to retreat from the market for some period of time. What are the kinds of things we should be looking for to give us a signal as to how consumers are responding to the economy over the next few months?
Well, luckily, we have a lot of data on that. Firstly, I would again mention there are income replacement programs in place, but they are necessarily rather fragile. And I would imagine a lot of consumers would be saving a lot of that income for the future as we enter into this new environment. We've already had some retail sales data for the month of March, which suggests that there has been, the usual suspects: hotels, airlines, eating out, leisure and hospitality in general. Spending has come down. Some areas have held up fairly well. Obviously, online spending, although it was initially for emergency goods. Building materials and gardening supplies. Apparently, folks are taking advantage of these lockdowns and doing some work around the house. So there have been some areas where there has been some growth, and also a number of the banks that we deal with share with investors their credit card data on a daily basis. So we can get an indication of where spending compared to, say, a year ago or since the start of the year has been going in different parts of the economy. And so that helps if you're looking at thematic investing to decide, what is priced in. And you can see those themes starting to play out a little bit in the market. But overall, I would say the aggregate level of spending is going to be lower because the areas where there's been some more spending are already, like hoarding, has already started to fall away. Things like department stores aren't going to come back, et cetera, et cetera. So a lot of themes within a story of an overall weak consumer spending story.
Right. And I will pass on the anecdotal from my conversations with local business people here in Palm Springs. Lots of applications out for federal aid. Almost no one that's received any aid as of yet. Thank you.
Yeah, we got to get that next tranche of money. Ms. Yee.
Thank you, Madam Chair, and thank you, John. I know we didn't touch upon this, but I was curious about an attachment to where there was some discussion about our liquidity analysis, and just want to get a sense about whether the recent market turmoil has significantly affected our liquidity analysis as you presented it in that attachment.
Is that a question for Eric?
Oh, maybe, yeah, I'm sorry, for Eric. I'm looking at you, but meant for Eric.
Okay, I think I'm back on. Ms. Yee, could you repeat that question for me, please? I was basically distracted. I think you were speaking with John.
Oh, yeah, no problem. I'm sorry. I'm looking at him, but I'm thinking about that. So I know we didn't touch upon what you presented in attachment 2 about our liquidity analysis, and wanted to get a sense from you about how the recent market turmoil has affected that analysis as presented here in our materials.
Well, I mean, I think the main thing is that basically we've been looking at the liquidity situation literally on a day-by-day basis. And what we have also done is to really work to maximize, I guess, the overnight liquidity that we have. So right now,
Eric?
the portfolio represents probably in excess of $15 to $17 billion.
Eric?
I think your volume is
on a nightly basis.
Eric, can you hear us, Eric? Eric.
A big problem.
I don't think he can hear us either.
Oops.
That's not funny.
Eric, can you hear us, Eric? Eric, can you hear us?
Am I not coming through?
No, you kind of muted.
while we are waiting for Eric to get back online,
Not yet, Eric.
Ms. Yi, Madam Chair and Ms. Yi, do you mind if I take on this question?
Yeah,
Well,
sure.
Eric is yeah. So, Ms. Yi, to your question. So, as we mentioned, that the balance sheet liquidity, enhanced balance sheet liquidity work the team did last year, we're benefiting from it greatly. And the liquidity management team every day, at least we get together once a day to talk about the market transactional liquidity, or what we call the trading liquidity, how that filter or how that is reflected or impacting our balance sheet liquidity. So every day we assess the situation, and we have developed a number of metrics to monitor our liquidity coverage ratio for overnight, for a week, for a month, 90 days, even up to 6 months. And we're happy to report to you that because of the work, most of the work we did last year, the team did last year, by building out a large number of diversified channels of reason liquidity. Remember, at this morning, the key feature of our liquidity management is make sure we have liquidity on demand.
Yeah.
Means that when we need it, we can turn it on. But when we don't need it, we don't have to pay for it. Remember, one of the philosophy is that too much liquidity can be costly, but too little liquidity is deadly. So we constantly are, balancing between having enough but not too much. But when we need it, we know where to go. And so far, as we said, that through the crisis, our hard work from last year is really paying off. So I think Erica was going to say it's a very dynamic situation. Every day, we assess the situation, monitor the situation very closely, reassess it, and adjust our liquidity position. And as one of the examples I mentioned this morning in the closed session, when the Treasury, some part of the Treasury and agency mortgages became illiquid, at least what the security was very liquid in terms of trading liquidity was very liquid in the last crisis. But this time around, 2 weeks or so ago, they became illiquid. And again, because of the work the team put together last year, we were able to quickly switch to a different financing source, and the framework is working. So I hope that answers your question, Ms. Yi.
Yeah, no, thank you. It's just, there is, I'm just curious about all of these, the interactions of just what we've seen over the last period of weeks, including the Federal Reserve's actions in terms of, excuse me, buying out treasuries, and then also injecting a pretty good amount into the short-term lending pool, obviously. So
yes. Just on that note, I have to say, in a way that this crisis really started out as a public health crisis.
Yeah.
Unlike the past crisis, right? 2008 was a financial market crisis, and then 2000, 2001, a tech bubble. That's a real economy crisis. But this time around, is a public health crisis, caused a crisis in the real economy. But so far, the Fed has been very effective in terms of ensuring that it doesn't turn into a financial crisis. So for that, so far, I would say that the Fed had made very decisive and very aggressive decisions, took very swift actions. And for that, I give the Fed a lot of credit for ensuring that the financial markets continue to function. And as you know, the fiscal policy are targeting the real economy. Yeah. So, we are addressing the symptoms, making sure the financial market continue to function. But the real economy is still a function of the public health crisis, of the pandemic.
Right. Thank you.
Oops. Okay, so next I have, Stacy, did you already ask your question? No?
No, I didn't.
Okay.
It's going to be quick, I promise.
No, it's my bad. There were other conversations here, so everybody got lost.
John, this one's for you. So I'm finding it hard to kind of model the projected economic impact of COVID because policies differ by state. It's just beginning to go up the curve in some countries, but other countries, they've already flattened their curve. How are you modeling this?
Well, we're looking at the data from Georgetown. We're looking at the data from Washington. We're looking at all kinds of different scenarios that are coming out of medical experts, and also the brokers are doing a lot of that as well. So the one scenario, for example, is the state that's been worst hit, which is New York State,
Yeah.
could start to, as of June 1, move to, say, stage 1 of relaxation, very modest relaxation. So we do think about it on a regional basis, but then we're also watching experience abroad, where countries like Germany and Norway have relaxed their shutdowns a little bit, and so has South Korea. And you've seen maybe a reflaming of cases in some of those situations. So I think that's a key issue for how long this recession is going to be. When you're talking about a typical disaster, you get a disaster and then you get a rebuild. It actually adds to GDP later on. But the scenarios we're talking about here are so wide. The estimates for US growth this year go from anywhere from -3% to -12%, depending on what you assume for the rate of cases, the rate of lockdown mitigation, things like that. So I would say right now we have an idea about what the investor community is assuming for the rate of recovery of the economy. The shape is actually called a swoosh, where you have a big, deep decline in activity and then kind of a bended recovery. But the range of uncertainty around that is huge right now. And so we do follow the data by state and region. We do follow the data internationally to try and get a handle on what we can expect. China is the obvious case where China flattened their curve out quite early. And then we actually have some good data from China about what happened in the first quarter of the year and then what's happened in the month of March and the early part of April. They have a lot of high frequency data that does tend to suggest that they had a very deep decline of the kind that we're expecting in the US. The return to work has actually been quite slow, particularly on the retail side. The production side has picked up a bit with the retail side. So one of the ways that we're looking at this is simply looking at countries which are ahead of us in terms of getting back to work, which is China. And so far, the message there is mixed. It's more like a little frustrating at how slow things are getting back to normal.
Thank you.
Sure.
Mr. Fechner? I have a question from you, it looks like. And my dog.
Not for me.
Okay.
Your mic's off, Teresa.
I think that was all the questions. So if there's another question that I missed, wave your hand at me. I'm not seeing any other questions. Okay, then we're gonna move on. That was, and that was trust level review, CalPERS 10B. We're on 10C. I think that is James and Anne, I'm guessing at this point.
Yeah, on the agenda item says Dan and Samiso. So Dan.
Samiso and Dan, I see it. Yeah.
Yeah. The media team, can you promote Samiso to be the panelist from attendee?
Hi, Samiso. You should be able to turn your video and your audio on.
Can you see me? Hello?
Yeah, we can see you.
Yes,
we can see you. I can't see your chin though.
Perfect. I think the lighting was made for the morning, and we ran until this evening. Thank you, Madam Chair, and good evening, members of the Investment Committee. If we could move on to slide 2. Before I jump into the actual presentation, I just want to spend a few minutes talking about the impact of the COVID-19 pandemic on proxy voting and corporate engagement activities. the 2020 proxy season is like no other that we've experienced before. We're having companies that are postponing annual general meetings. Some companies are moving from in-person meetings to virtual-only meetings. So we're not the only ones who are having a virtual meeting. And some companies are even canceling engagement calls that we have with them. What has changed for us, if you look at our approach in terms of what we're looking at, is that for every engagement call that we're having during this time, during this proxy season, we're actually starting asking companies and discussing the impact of COVID-19 pandemic on their business operations, on their financial condition, on the human capital management, consumers and communities, and asking the companies to explain to us the board's role in oversight as far as this pandemic is concerned. So really, we have shifted a little bit in terms of our approach in terms of the engagement to emphasize these issues, because we think these are issues that matter quite a lot, and we understand that each company has, the case for each company is different, and as such, really, there is no one case fits all. Some companies are struggling under, financially, but while some companies are able to do more for their workers and so forth. Having said that, I'll jump into the actual presentation. If we can turn to slide 2. Really here, I won't spend too much time on this slide, but just to say that we are right at the peak of proxy season, and we are going to be voting over 8,000 annual general meetings between now and the end of June. Our priorities really haven't changed. We have the 3 main priorities in terms of our engagements, which is climate change, corporate board diversity, and executive and employee compensation. Again, if I sound like a broken record, it is a good thing. These are things that were identified through the ESG, the 5-year ESG strategic plan, which was adopted by the Investment Committee in August 2016. So these are the priorities that we're looking at. And then situationally, we do look at other things as issues arise. Moving on to slide 3. Really, this is looking back at the 2019 proxy season. Again, I'm not going to spend a lot of time on this slide because you have seen some of this information. But just to highlight two areas in terms of improving corporate board diversity, we've seen that companies that we've engaged have added, 53% of the companies that we've engaged have added diverse directors to their board. And again, to emphasize in terms of diversity, our definition of diversity is all encompassing. It includes skills, race, gender, ethnicity, sexual orientation, gender identity, all the aspects of diversity. So when we engage with these companies, we emphasize that they need to look at all the elements of diversity. And then on executive compensation, this we think is really important because this is the issue about alignment of interest. And we think that company executives should be paid only when shareholders are also getting paid, and only when they're taking care of their employees. Everyone on the stakeholders are actually getting a good deal. So we look at this really from a quantitative perspective as well as qualitatively. And last year we voted against 53% of the Russell 3000 companies on executive compensation. I won't go into the appendix. The rest of the slides really go into detail in each of those 3 areas that we're focused on. But I'll stop here and take any questions.
So we're going to have to think about where we put proxy voting reporting in the next investment committee. So I will just say, there's a couple of questions I have for you. So one is, out of the 22 companies, 6 are Japanese. Notable successes include public comments, and then 70% of California Climate Action 100 setting long-term emissions. What are the 22 companies that are we leading those engagements, right? That's what it says?
Yes, we're leading
those 22 companies.
Yes. So some of those are global companies, some of them are US companies, but 6 are Japanese companies in terms of those. I'm trying to recall whether I know that we don't publicly
I
state
know,
the
and we
companies
don't
that
have
were
to say
involved in
it.
the engagement in, but
Yeah.
we can provide the information to the board after the fact in terms of which companies exactly that we're engaging.
Sure. That would be great. And then the 70% that pledged long-term emission reductions and provided commitments to TCFD aligned reporting, is that up from a year before? Or is that in addition to, or is that total?
Well, this is the total, and we had our first annual progress report for the Climate Action 100 last year. It was the back end of last year, and so we're going to have another, a progress report again towards the end of this year, and those numbers are going to change. So those numbers are based on the last annual progress report that was reported under the Climate Action 100, and that 70% is not just the 22 companies that we're looking at, but the entire, Climate Action 100 companies.
Okay, that's what I kind of thought, because it looked like it could be one or the other, but I wasn't sure. And then lastly, you had mentioned that you were asking some of the companies we're engaging with, what is their COVID-19, response kind of looking like as you're engaging, inclusive of human capital. And I asked John earlier if we're seeing any kind of a connection here, that we kind of have not looked at the S and the ESG very well in terms of a material risk to our investments. Now that we have a pandemic and our supply chains are disrupted and people can't work, and I mean, are you getting any kind of feedback on that since you were asking those questions?
Yeah, we are getting feedback, and it's different from different companies. I think what this pandemic has done is really to bring the issues of sustainability to the core. Even people who maybe didn't believe in ESG or sustainability, now they're looking at this and they're actually seeing that as a real impact on the bottom line. So we're seeing this, and I said, different companies have different, are doing different things either for their workers, their companies that are actually giving full pay and benefits to workers who are not able to work from home, so they still get full pay and benefits. There are companies which, due to their financial conditions, are unable to keep workers at work, or the workers can't go to work, so they're following workers, but they're keeping, they're still, keeping the benefits for them or something like that. So again, it depends. Each case is different. There are companies that have said, if someone is sick, they don't have to use their sick leave. They have unlimited sick leave because they don't want people to be forced to come to work because they're afraid of running out of sick leave when they're not feeling well. There are companies that have turned their operations to provide some of the materials or PPE that is required by the community at large, and so forth. So really, there's a range of activities that is coming from different companies, and good actors. Really, there are good actors out there, but there's some companies where their financial condition is so precarious that really they can't do anything but just hope for the best.
Well, there were companies that their financial condition is not precarious, and I can name a few, but I'm not going to do that on public session, that are not treating their employees well. And I think that, one of the things that this pandemic has also exposed is the extreme inequality for workers, and that's where I think the S and the ESG really comes in. If you're throwing these people out of work and then you don't have a workforce to come back because they're on the streets now, I mean, at what point, somehow or another, this has to be thought about. And there are more than a few of our, Fortune 500 companies that are not treating their employees well, and or did not start doing so until it started getting press. So I just thought I'd bring that up. Anybody else have any questions besides me? I'm holding us between dinner, and I get it.
It's been a long day.
It has been a long day. All right, I see no other questions. Everybody's talking about dinner, so I am,
Ms. Taylor, I'm seeing questions from Ms. Yee and Ms. Olivares. Ms. Taylor, looks like you're on mute still.
so Ms. Yee?
Just a comment. I wanted to just congratulate the team, Smiso, Dan, Ann, for the leadership in all three of these areas. Climate Action 100 Plus. I mean, the idea that we're moving so many of these companies to look at setting long-term emission targets is really phenomenal. So it's been a long time coming, and that workload is or that work is continuing. The corporate board diversity, I did have a question on, and that is we had it looked like a lower number of what was it in terms of how many we voted against, 314 directors versus 468. I wanted to know if the lower number actually reflected progress or whether it was a different tactic.
You are correct that the lower number actually is a positive. It means that the companies are doing what we're asking them to do, and we'll continue to use any and all of the investor rights that we have. We have instituted, vote no campaigns at some companies which have not responded to us. We were voting against the board chairs and members of the nominating and governance committee. So if you see lower numbers, that's a good thing. It means that we're making a lot of progress.
Good. And then lastly, your new pay for performance model, are you finding that it's improving your ability to analyze executive comp, which is probably going to be an area that's going to be heightened in terms of attention, focus on it with the economy and COVID?
It is indeed. And the feedback that we're getting from companies has been positive in that what they've said is the fact that we've been willing to be transparent about how we're analyzing them from a comp perspective, because we actually put the description of this model on our public website, so they can calculate themselves on their own and see how they score just following what we're doing. And the fact that we've extended it to do 5 years, whereas typically a lot of people look at 3 years. So in our discussions with companies, what we've found is that they've said they appreciate the transparency, and it makes those discussions much more enriched, because really at the end of the day, now the numbers are the numbers, and they can verify those numbers, and then we're actually able to get into the nitty-gritties and understand what might be driving the issues as far as performance is concerned.
Great. Thank you. Great work. Thank you.
Thank you. Stacy? So sorry.
Thank you, Madam Chair. I want to be really quick about this because it's after 7 o'clock and everybody's been very patient. I think it was at the December board meeting, I asked about looking at the intersection of diversity and board diversity, but with women, so women of color, because our numbers are very few in investments and when it comes to leadership. I don't even think our investment committee has had a woman of color as chair ever. And so I want us to be able to take the lead when it comes to this. We had talked about that as an indicator. Are we going to start capturing that?
The answer that I have there is that right now there are studies out there that have been done, whether there's MSCIS or other studies that look at diversity or the number of women at boards and relationship to performance. Once you start getting into race or ethnicity, I think there's a depth of studies out there. The numbers, when you look at them, the numbers are really, really low.
I'm going to keep pushing. I'm not giving up.
I understand, and we'll also keep pushing. When we're engaging with companies, we really emphasize the fact that they should look just beyond gender and just go into the race and ethnicity and so forth. We've been in touch with a number of organizations, including the Latino Corporate Directors Association. We're actually in the process of organizing a meeting with them So we talked to different affinity groups in order to try and address that particular issue.
Okay, we'll continue on that point later. And then with crude oil crashing today, I think we're going to get some additional pressure from groups regarding our need to divest or take some long-term initiatives. So I just wanted to put that on the radar.
It sounds like something fell there. Go ahead, Samisa.
So was the question that with crude oil, we're going to get additional push to divest? Is that the?
Oh, yeah.
That's the expectation. I think, is sometimes the issue with investments is that, or anything else in life is that hindsight is 2020. And it's easy for people to look at the situation and push for divestment. I think we have said before that really, we don't believe that divestment is the right way to go. We believe in engagement. Until that is something, if we change that as the investment office, that's something which is obviously for the investment committee to think about. But at the end of the day, again, we're engaging these companies. Some of these companies are announcing plans to transition to a low carbon economy. Just last week, Shell came out with an announcement that really they're moving to net zero, and they're looking at even supplying, when they're supplying to customers, they want to supply to customers who are focused on net zero carbon emissions. So we're seeing this movement even within the companies that are actually producing oil and gas and so forth. We are moving into this transition.
Okay, thank you very much.
Just to add to that, it would be nice if we could get like JP Morgan to stop funding the pipelines. That would be another really good idea. However, I'm just going to leave it at that because we could have that conversation forever. I have no other comments that I'm seeing unless I am incorrect. Lisa, Ms. Middleton, thank you.
Thank you, Madam Chair, and I will keep this very short. I want to thank staff for an outstanding report, and I really appreciate that diversity and inclusion was fully inclusive, including sexual orientation and gender identification. Thank you for that. We still have a dearth of data and need far, far more metrics, and I applaud any efforts that you can make in that direction. Thank you.
Thank you.
And again, yes, I reiterate that this is a great report. We thank you guys, all the hard work you guys do. Proxy season can be a mess. I can't even imagine what it is under COVID-19 right now. So again, thank you very much for all your hard work. And we are moving on to yes.
Madam Chair, we do have one public comment.
At the end of C, you are correct. Go ahead.
Thank you, Madam Chair. Kelly Fox again, reading on behalf of the submitters. This one is from Sheila Thorne, subject 420 Investment Committee meeting, item 10C. My name is Sheila Thorne, and I'm a grateful member of CalPERS, as well as a member of CFA, Retired, and RPEA. I am commenting on item 10C. It's apparent that CalPERS considers stakeholder engagement a major way to abate climate change. I question the effectiveness of this strategy. As summarized in a recent Harvard faculty study reporting by ESG, PRI, and Climate Action 100 Plus was slow, often based on voluntary participation, and produced data with up to 30% error. There are few provisions for enforcement mechanisms, and investment in fossil fuel companies that explored for and developed new resources persist. Analysis by As You Sow, a nonprofit leader in shareholder advocacy, shows in its 2020 report that oil and gas companies continue to ignore demands from science and shareholders to adjust plans realistically to be compliant with Paris goals. In fact, according to PricewaterhouseCoopers Oil and Gas Trends 2018 to 19, oil and gas rig activity level has been rising and major projects are being approved. ExxonMobil, for instance, as well as Total and Chevron, plan to increase production. Last year, ExxonMobil outlined an aggressive plan to more than double its oil production fivefold in the Permian Basin and start up 25 projects worldwide. No amount of clean and sustainable methods of extraction can make up for the Scope 3 emissions released by the end use of this product. The only way to become carbon neutral by 2050, let alone to prevent climate disaster by 2030, is to leave the fossil fuels in the ground. Yet rather than changing their business models in a meaningful way to alternative energies, the oil and gas companies remain all out to extract as much oil and gas as they can while making as much profit as they can. Shell's plan to cut the carbon footprint of the product they sell by only 30% by 2035 and only 65% by 2050, rather than net zero, leaving the rest to consumers. ExxonMobil and Chevron continue to refuse to take responsibility for reducing emissions from the burning of their products. In parentheses, Union of Concerned Scientists, 4/17/2020. The world is facing the crisis of extreme climate disaster in the very near future, along with more frequent pandemics. Engagement has not so far led anywhere, and we're running out of time. Please consider divestment of fossil fuel shares, which are toxic in practice, both ethically and financially. End email.
That was it?
That is the only one. We have one more for the last subject, item 12.
That's what I thought we had. Okay. So we are on item 11, summary of committee direction. That would either be Dan or Ben, I think.
Yep, I'm happy to take that one. I just saw Ben unmute. Ben, you want to
There
take
we
that
go.
one? Or do you want me to take it? I'm happy to take it if you'd like.
Yeah, I only jotted down one based from Ms. Oliveras about the COVID-19 adjusted, plan of our risk mitigation segments. Other than that, I don't have any. I did not write down anything. Do you have anything additional?
We have the one other from closed session that was consolidated, Ms. Yee and Ms. Olivares' request that will come with. And the only other thing I had was that there was the request for consultant reports quarterly.
Excuse me.
So we need to think about what that looks
Dan?
like. Yep.
It's not, if you're talking about something that happened in closed, that's not for now.
Oops. Okay.
Thanks, Matt.
So
Yeah, also on that note, Dan, the closed session, the committee director, I think you summarized very well. The Madam Chair and the two board members, they agreed with you. So I don't think you need to belabor the closed session committee direction anymore. So open session this afternoon, I noted down one from, again, Ms. Olivares on the COVID-19 adjusted risk mitigation plan. Basically, the interaction of COVID-19 and the global financial crisis 08-09. So that's the one I noted down from Ms. Oliveras this afternoon. In open session, that's all I have.
And Dan, wasn't there an update on having more reports on the total fund? Wasn't that also part of it?
There was a request to have quarterly reports from the consultants. So I think what we can do is talk to the consultants about what that looks like.
Okay. I also don't want them to stop their work to produce more reports, but absolutely, if it will help us kind of see and navigate this whole, downturn because of COVID, that might be helpful.
It was Madam Chair. Sorry, Madam Chair, my understanding that request was to both board consultants. So it shouldn't be in the summary direction to the staff or to the management. That is really requested to the two board consultants. That's my understanding.
You're correct, and it did come, and they did say that they would come back to us. So, no other board direction, and I appreciate it. Thank you, everyone. And our last item is item 12, and we have public comment.
Thank you, Madam Chair. This was submitted by Mr. Joseph P. Ruiz. Subject, CalPERS public comment item 12 for Monday, April 20, 2020. Dear Board of Administration, money masks a prolonged indifference to oversight at CalPERS. The judge in my lawsuit against the CalPERS Board of Administration, in parentheses 18 STCV 06908, encouraged me to contact the members directly after I told him that the board didn't authorize the legal department to respond to my lawsuit in pro per in 2018. This wasn't the first time that the CalPERS staff had usurped the power of the board, as I've witnessed no internal oversight the past 4, in parentheses number 4.5 years since I filed a complaint against City of Industry, a CalPERS contracting agency. I discovered the board violated the Bagley-Keene Open Meeting Act, in parentheses Government Code Sections 11120-32 in August and September 2017 by not deliberating my request to order staff to complete the City of Industry investigation after staff members from Audit Services and the Employer Account Management Division failed to contact city officials on my allegation of false responses on a state document. The CalPERS Employment Relationship Questionnaire of July 2011 about me in violation of Government Code Section 20085 and Penal Code Section 115. The legislature created external oversight through legislative committees on this agency, but they're looking the other way. The Bagley-Keene Open Meeting Act has taken a lot of abuse over the years from CalPERS, as reported by NakedCapitalism.com and CityWatchLA.com. It's tragic the major newspapers don't cover the state agency closely. I brought a motion for a preliminary injunction in Los Angeles last summer on a closed session meeting violation from June 19, 2019, but as the CalPERS attorney and I looked on, the judge announced he didn't have my filing, and instead of postponing the hearing, he dismissed it. The state court used Bagley-Keene as a punching bag too. The judge ruled in October that the board was immune from my charges, but I later discovered my lawsuit was discussed in closed session throughout 2019 without public agenda notices, and that the board keeps verbatim transcripts of the closed session meetings. The board has begun to start their meetings, and we are out of time. 3 minutes.
All right.
That concludes the reports, Madam Chair, and I've confirmed that I have a face for radio and not the voice. Thank you.
Thank you, Mr. Fox. I appreciate it. So seeing no other public comments, no comments from the board members, this investment committee meeting is adjourned at 7:19.
See you all in the morning.
See you in the morning, bright and early, 8 a.m.
Have a good night.
Good night.